On today's show, 3 questions. Number 1, where is money being made? Number 2, how has the S&P changed over time? And number 3, what in the heck does the NBA have to do with picking stocks?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dennis Money's 2 Cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. Rabih, last week you did a show without me.
Yes.
And I was feeling really bad about myself. Like you guys were moving on without me. So then I was like, you know what? We're just doing a show, me and Rabih, so I can get more attention. So, okay, that's not really true. We just couldn't get any of the other guys on because it's just a busy time of year. But I'm glad to be here with you as always. Really quick as we start, I'm giving the ultimate shout out to longtime fan. I don't know of the show, but I think she's a fan of me. She's a fan of our team. She's a big fan of our team. Shout out to my daughter, Millie. She's 7 years old today.
Happy birthday, Millie.
Happy birthday, Millie. She's not going to listen to this, but I'm still going to give her a shout out. I gave her presents this morning. We're going to go do a little birthday lunch today. We're doing a birthday movie tonight. We're doing a whole celebration today. It's a whole thing. Yeah.
I should invite you to my birthday.
Yeah. Yeah. My kids, I'm openly spoiling my kids. I fully admit it. They get, like, my son turned 5 last month. He had like a whole weekend's worth, multiple parties, all sorts of things. He turned 5 and then Millie turned 7 today. We're doing friend party today, family party tomorrow, movie. Like, I'm just like, there's no chance she does not grow up completely spoiled, and I'm here for it.
Yeah, that is fun. I'm going to take this podcast and send it to my dad and told him, you missed out.
You're failing me, Dad. No, we're going to see Toy Story 5 tonight. I've heard good things. I've heard mixed reviews. Shout out Jake Elm. He was not a huge fan of Toy Story 5, so we're excited to go see it. So,
okay.
Anyway, let's jump in. Feels good to be back, Rabih. We're going to do a little mid-year check-in. Where's all the money being made?
Where is all the money being made? Because honestly, last week, and you missed out on this. Last week, I went on a date. My first date ever with Kevin Warsh, because it was.
I was like, wait, what?
I caught you off guard. I did.
I was like, where's this going?
I caught you off guard. So Kevin Warsh had his first press conference as the chair of the Federal Reserve. And honestly, the market was living until that moment. Since then, nothing has changed. And now we're waiting until they meet again in 5 weeks. There will be like the earnings season in between, which is going to be very impactful to understand sentiment going forward. But the Iran situation is mellowing out slowly, but it's more political than it is economic. And
that doesn't seem like the U.S. That's weird.
Making
things political
and not economic. And then this is a chance for us. It's because we don't have a lot of news happening this week at the market. This is a chance for us to take a deep breath and like zoom out. And it kind of coinciding with the fact that we are halfway through the year, which feels surreal to me that we're halfway through 2026 already. So let's zoom out and look at asset classes and the economy and see whether on a 6-month time frame everything makes sense or it doesn't. So I don't know if you looked at the numbers or the stuff that I posted, but
nope.
What's your hunch? What's your hunch? Remember, like, gold was doing really well and silver at some point. Stocks with the tech, semiconductors, they're facing a memory crunch, so those are all going up in price. The dollar was zigzagging. Like, where do you think, what was performing best? Where was money made?
Yeah, I mean, I think I cheated because I saw, not on your chart, but I saw something earlier that gold has flatlined and actually pulled back quite a bit. I mean, my hunch, if I wasn't looking ever and I was just hearing the narratives and storyline, I would think anything AI related has crushed everything.
Everything AI related, especially semiconductors. And this was reflected actually in small cap companies. So the best performing companies year to date are small cap. If you measure them through like the Russell 2000, they're up 22% year to date.
The tilt is working, Rabih. The tilt is working.
Followed by developed markets ex-US. So we're talking Europe, we're talking Japan, we're talking like Europe, Japan, and Canada type of vibe. This is developed markets ex-US, and followed, I would say, by a globally diversified portfolio across the whole spectrum.
Shout out.
Up 10% for the year. After that, you've got emerging markets are up 9%. And the story with emerging markets is that countries like Korea, whose stock market is 85% one company, which is Samsung, have been skyrocketing. Like it is so interesting to look at the chart of one company and seeing it go straight upwards, but then looking at the ETF of the country itself and seeing it go all the way upwards.
It's all just relying on one company.
Which puts Korea in a very vulnerable position for someone who's overexposed. South Korea, of course, everyone. And after that, we've got the US market at 9% overall. The S&P 500, so only the top 500 companies in the US market, are up 8.5%. And then you've got long-term treasuries are at around 2%, intermediate term treasuries down around 1% too, and then gold is down 5% for the year, and then Bitcoin is down 31% for the year. So if we look at it from that perspective, you've got international markets doing better, but not too much. Small caps are doing better, and bonds are flat. This tells you that the prices reflected in the markets like that of a growth story. We are doing well. Whenever we feel like the economic situation is not that good for business, small caps usually take the hit first. But economic conditions are favorable, even though the Federal Reserve kind of hinted last week that
the rates are going up.
The rates might be going up. They're not going down. The market already priced a hike for the end of the year. So these are where global asset classes stand. But if we want to go and zoom in on specific sectors within the US, here's where they rank. So, and this is not as clear of a story, but the best performing was technology at 28%. And this is in line with the growth narrative. But the second best performing was energy with 22%. And that is related to the supply chain shock that happened from the Iran war. Usually it's either tech or energy, and they go against each other. This is one of the moments where we have a strong economic narrative, but also we have supply chain constraints with energy. We will see how energy does moving forward, because oil literally plummeted from the mid-90s to the high 60s in the last couple of days. So we'll see what that means and the impact of that on oil revenues.
Rabih, I want to ask you, what's driving tech? Because we were talking before we went on that I think is interesting, breaking down the S&P 500 a little bit deeper into three categories. So the overall S&P 500, this was a couple of days late. So this was as of, I think, June 23rd. So you said it's about 8.5% now. At the time, it was about 9%. But then the second two categories within this are, we'll call it the S&P 493. So everything minus the Mag 7. That's actually up almost 15% if you remove the Mag 7. And then the Mag 7 themselves, year to date, they've had a pretty big drop over the last month or so. Year to date, only up about just over 1%. So I'm just curious with that, what's driving, technology as a whole has outperformed everything, but not the Mag 7. The Mag 7's actually been kind of getting killed.
Yes, because the Mag 7, not all of them are considered tech companies per se. Some of them are considered consumer discretionary or communication, right? So it's much larger. But at the economic level, here's what's happening. We had a period where all these larger companies were making enormous investments in building data centers and expanding capacity. And as these news were happening, remember, they were buying chips from each other, and they were telling them, oh, we commit that much.
You went over that whole chart. Yeah.
Exactly. And you invest back in us. So what happened with that valuation really rose before we saw any tangible impact from the data centers. And with oil prices being high, making electricity super expensive, I wouldn't say the narrative went away, but the narrative kind of took a breather on data centers. And this is how you know that the growth, I'm not saying the Mag 7 companies are not solid, robust companies, but on top of their solid, robust growth, there is the valuation. It's just the market narrative. And the market narrative moved away from these data centers for a slight bit to what we now call memory. So just like your hard drive, your USB, your micro SD, or your cloud storage, what's happening lately is that there is a shortage in capacity for memory. And that capacity of memory is needed for any AI model to train. And that's why we see companies like SanDisk, those companies that make the micro SD for cameras. This is how
Up
they're
like
known.
4,000%.
This is why we see Micron going up. So what happened is the narrative slightly shifted away from data centers to memory. And that memory is having an impact. Out of the Mag 7, which is Apple, this week, the news was Apple was forced to increase the prices on its MacBooks and iPads because buying these memory chips has become more expensive, and they decided to pass this cost on to consumers. So Apple decided to increase their prices as a impact, as they're impacted by the memory
That's
shortage.
unfortunate because I'm in need of a new phone. So
they are going up, but the stock price of Apple itself went down on the news. So usually when a company announces that they're raising prices, it tells you that, oh, they're going to be making more money. That is why stocks in general usually can keep up with inflation, because if inflation shows up, they'll raise prices on the consumers, they'll protect their profits in a sense. But in the situation of Apple that we just saw, Apple increased their prices and the stock price went down, which tells you that market expectation is that the consumer is not going to stomach that increase in price. That increase in price is going to lead to lower sales
no,
for Apple.
it won't, Rabih. No, it won't. Until proven otherwise, this is the ultimate innocence or proven guilty, but maybe the opposite. Like, we are spenders until proven we're going to hold back. Like, I'm sorry, it's not going to happen.
Interesting. But it's also related to the fact how Apple positions its brand. It is a premium product, right? It is a product that outside the US, people save a couple of months of their salary to buy the Apple products. So they think with this increase in Apple price, they're actually eliminating some of the lower consumers that drive revenue. That was the narrative.
But here's a genuine question. Does anyone, I don't know this, just does anyone buy an Apple iPhone cash anymore? Like, ever?
I do.
You do?
Yeah.
Oh, I thought I haven't bought a phone for years, so I truly don't know. I'm still on the 13. I'm maybe embarrassed to say. But as far as I've always thought and purchased phones, it's kind of just through the carrier, and it's just like a monthly payment, like part of your payment is $20 a month or whatever. You might be the only person I've ever known that's bought it cash.
This is because I think I bring this with me as I immigrated to the US. In the US, it's only in the US where you buy your phone from your carrier. Outside in the rest of the world, most phones are unlocked. You can put any carrier on the phone. So they are two separate transactions. And Apple sells more outside the US than they do sell in the US. So that is something to take into consideration when you're calculating the revenue from Macs or iPhones.
So is your phone from when you immigrated? So we both need new phones?
No, not really. You can actually do this in the US as well. On the Apple website, you would buy an unlocked iPhone. And when you buy an unlocked iPhone, they don't give you the option to do installments through a carrier. You just pay for it up front.
Well, and then what do? I buy the unlocked iPhone and then I can switch over all my stuff?
So what happens is that back in the days when we used to do physical SIM cards, remember? We're going off a tangent here. Back in the days when you could do a physical SIM card, if you have an unlocked iPhone, you can just, wherever you travel to a different country, just switch the SIM cards. Now you do the same thing, but with an eSIM. So I have an eSIM for an American carrier, but I can also just move and get any eSIM from the rest of the world.
This is the selfish portion of the podcast where I'm just learning from Rabih how I update my phone without having to go to the carrier, because there's very few things worse. It's like maybe car dealerships. It's like car dealerships and phone, like going to the phone, like T-Mobile. It's awful. I can't stand it. So if I can do this on my own, Robbie, we're going to talk off air.
We're
going
gonna,
to
yeah,
chat.
I'm gonna put something on your calendar where we just
me,
talk about this.
This is me just learning from you how I do this with avoiding T-Mobile store. Yeah. So sorry. Continue, please.
Where were we going with this?
I don't even know.
We were talking about how the Max 7 took a hit, but I think the hypothesis that I have, I don't know, is that while they are still good companies, their valuations were elevated due to a data center narrative, and the narrative has now moved to something called memory. And until that, shifts back, we would see them struggling. If you think of it long term, this is buying the Max 7 at a discount. That is when stuff like that happen. So you were telling us that the S&P without the Max 7 does better than if you include the Max 7
incredibly this year. This year it's the S&P 493, so everything minus the Mag 7 year to date is up about 15%. That's a couple of days late, so it's probably, who knows if it's changed, but somewhere around 15% compared to the Mag 7 specifically is down or is up just over 1%. So it's kind of a flip, to be honest, of what's happened over the last 10 years, which is everything else in the S&P is carrying the Mag 7.
Yep.
Where for the last literally decade, it's been the complete opposite.
I would think of it as this is a breather where those other companies are catching up to the Max 7. And the fact that one is going down and the other is going up tells you that big money institutional managers are rebalancing their portfolios, where they are removing the overweight from these Max 7 and putting it back into the small caps, the remaining 493, etc.
Yeah, it's interesting. And then for the total, it's up what, over 8% for the year. So it kind of equals out, but it's just kind of a interesting narrative switch.
Yep, exactly. So Mag 7 is part of the stocks, right? And stocks are up this year. We mentioned that bonds, whether it's short term of the curve or long term of the curve, they are flat. And we talked about gold, how it is down. So you've got stocks up, bonds flat, commodities down, and then there's the most important one, which is currency. The US dollar, when this administration started, they were all about like the US dollar is at its highest value vis-a-vis other currencies. We want the US dollar to go down because that is better for American business. We were during the Liberation Day phase where we're launching a trade war against every other country on this world. We wanted the US dollar to be small. But there are macroeconomic realities and currents that you can't avoid. The fact that the US is a country that always goes into debt on an economic level, like we have deficit every year, the debt increases. The fact that we're a country that imports more than it exports, and we are the consumer of the world, this on the math, on pen and paper, makes your currency appreciate vis-a-vis other currencies always. So even if the administration was trying to lower the dollar for a certain period of time, whenever a macro shock happens and the cycle goes back on its track, the natural terrain, we were going to see the US dollar appreciating again. And from the beginning of this year until now, we are seeing it as well. That is why last year developed and emerging from the perspective of a US investor crushed, whereas this year developed and emerging haven't done as well from the perspective of a US investor. And that's not because those foreign companies are not doing well or their stock price isn't going up. It's because the US dollar is strengthening and it's eroding your international returns. So I've got you some data actually on the performance of global investments, whether they were hedged or unhedged. So if you're investing in a globally, in all the international markets except the US, and you're still exposed to the US dollar, so if the US dollar appreciates, that lowers your return, you would have made 13.8%.
In what index?
The whole index except the US. The whole world except the US.
Got it.
Okay? But if you decided to hedge yourself against an appreciation in the US dollar, you would have made 17%. So there's a 4% point difference, not because the stock market did bad, it's because the US dollar erased 4% of your equity return if you're a US investor investing in the rest of the world. However, an investor in France investing in the US stock market, they had their return appreciate by an extra 4% because of it. And over a 20-year period, the difference between 20 to 40 actually is a very long cycle. The difference between a US investor versus a foreign investor, they should cancel out. But we are experiencing that transition from it's favorable to invest internationally to it's not as favorable to invest internationally. And if you want to split it down even further, like in Europe, if you are still exposed to a strengthening dollar, you would have only made 9%. Whereas if you hedge the US dollar, you're making 13. And emerging markets, and emerging is where Korea is and why emerging is doing really well. If you were exposed to the appreciating dollar, you would have only made 24. But if you hedged the US dollar, you would have made 27 year to date from January to now, 27%.
Interesting.
So what we have is a strengthening dollar, stocks going up, which are, we just mentioned that stocks have the ability to outpace inflation. US dollar means that there are expectations that the US Federal Reserve will increase interest rates and money will flow into the US, and gold is going down, which means people are leaving gold in favor of the US dollar because interest rates are going up. So if we just look at the market tells you we think an inflationary period is happening. Bonds are going flat, commodities, because they don't earn a real rate. Like gold doesn't give you coupons, doesn't give you interest rate. So whenever there's a country that's increasing interest rates, we're going to sell out of the bonds and go into that because we're going to earn more in real returns. Stocks, due to their pricing power over consumers, are pricing in the fact that they can withstand the inflation. So the market thinks that the period going forward is good growth, but is also with hints of inflation. So if we look at this, this is the market. This is what the market is saying across all asset classes. If we look at on pen and paper what we have about economic growth, well, the GDP is running around 2% where we want it. Unemployment rate hasn't changed from like kind of October last year.
Yeah, just stays
flat labor
4%.
market. Exactly. Interest rates hasn't changed. But what we think inflation is going to be for the end of the year is probably higher by 75 basis points or almost 1%. So what we are seeing economically in the data is also being reflected in the dynamic between asset classes. If you look at the stock market on its own, you're not going to understand it. But if you look at the stock market compared to bonds, compared to commodities, compared to currency, you may be able to see what economic narrative do these four together tell us. And it seems like the narrative is very consistent. If we expect the economy to be stable, but just add a little bit inflation to it, we would expect that stocks still do well, commodities take a hit, and the dollar strengthen. And this is what we are seeing.
That's a lot, Rabih.
I know it's a lot. It's do you know that meme? I don't know if it's from which TV show is, but there's that guy with the pictures and the red thread, and he looks like he's explaining a conspiracy theory.
Oh, yeah.
This is how it feels when you always look at different markets and you're trying to make sense with them economically.
Yeah.
Thanks for joining the TED Talk.
Yeah. No, I think it's great. Every time we go through this, the thing that just always stands out to me is just how complex all of this is. And we can't emphasize enough or remind people enough that if you try to outguess this, you'll lose almost every time. Yeah. Short term, long term, whatever. Just it's going to be difficult to navigate this. I mean, coming back to what you said about Apple, on this news of what happened with Apple raising its prices, you're saying normally we'd see it historically, the response being stock going up on that news. Mm-hmm. For whatever reason, it's gone down. Or you think about what's happened with the Mag 7. I remember, I'm old enough to remember, Rabih, not too long ago, that the narrative being like, is the Mag 7 ever going down? Is this should we just be investing in the Mag 7? Like, I was getting questions about this.
Yes.
Why would we invest in anything but the Mag 7? And we are now living out the example as to why you would invest in other things.
And it always happens. I'm not here to dance on graves, but there was a period
other
where...
than Bitcoin, other than crypto and Bitcoin, we're not dancing on graves. That's the only grave I'll dance on all day. I will do the cha-cha on the Bitcoin grave all day.
And here's the thing. If you're going to play the game of dancing on graves, you're going to dance on the grave of every single investment out there. They keep rotating. There is a time where you're just better off staying in equities, which is what we were seeing in the last 15 years. But are you telling me that forever the best investment is just to stay in equities? Absolutely not. I'll be super naive. Bonds will have their place back in portfolios. They just didn't when interest rates were zero, and now going from zero back up to like a healthy higher level, right?
Yeah.
If you're going to be dancing on graves, you'll always be rotating. It used to be Mac 7, used to be Bitcoin. Now it's semiconductor and memory chips and energy for this year. But then if oil keeps plummeting below 60, then suddenly energy will be, buried. And it's going to keep rotating. So how do you, it's a rat race, but instead of you working yourself till death, it's just moving your money till death until you lose your money. So how do you avoid this? The simple answer is buy everything, right? Be globally diversified.
That's boring though, Rabih. That's boring.
That is boring, but this is not, it is boring, but also buying everything has different ways for it to be done. So once you dig into the details, like how am I buying everything? What is it costing me to buy everything? And as I adjust for my portfolio, am I still exposed to everything? Yeah. And this is where it gets nuanced, and I can't talk about it forever. But if the answer is buy everything so you can avoid this investment rat race, the next step would be I need to learn how it's done correctly.
Yeah. I mean, and this is why we talk about this a lot with people, of this idea of A, you're never going to outguess this, but B, to your point, there is a systematic way to do this properly. This is why we do what we do. It's a huge job to be done, is being proactive with your investment strategy. And we are not, despite what people might think, because maybe we've done a poor job at Dennis Advisors of highlighting our strategy. We are not proponents of like just sit on the S&P and wait and do nothing. So yeah, it's far more complicated than that and more systematic than that. But yeah, you're right. Fundamentally, if you're trying to outguess this thing, again, every time we go through something like this, I'm just like, how could you ever outguess this? You never will. I don't love that you're putting water on my dancing parade on things, at least on Bitcoin, but it's fine. It's fine.
Even the S&P 500, you can dance on its grave so far this year.
Yeah.
It's up 8.5%, which is great.
But everything's beating it.
Small cap is up 22%.
Yeah.
Right? So, you can always find a loser to dance on their grave. So instead of being stuck with one.
Yeah, which is kind of our thing at Dennis Advisors. Like, let's find the losers and point and laugh at. No, I'm just kidding. We don't do that. We don't do that. We understand. But it's it's almost as if you were getting us set up for the next segment here, Rabih.
I definitely did it on purpose.
Yeah, we're professionals here. But we wanted to talk about, these next two will be relatively brief, but I think interesting to talk about. Next segment here, talking about how has the S&P changed over time. As we get to this next segment, I want to do a quick reminder. This show is brought to you by Dennis Advisors. Education is a big piece of what we do. And I want to remind everyone we have our next cohort coming up in September of the Dennis Money Launchpad. Everything you were not taught about money in dental school, we got you covered. You can go to dennismoneylaunchpad.com. It's like that little middle section promo there, Rabih. Just for you.
People need a breather after all
They need a breather. They need a little transition here. Exactly. So kind of taking what you talked about, Rabih, there about just how the S&P has changed over time. I heard something super interesting that caused me to do some digging. And then you and I were talking before about just how, we want to highlight this in more detail and give evidence to how things change over time with the economy. In this case, the microcosm of that being the S&P 500. So I heard this on or somewhere, I can't even remember where, but it again caused me to kind of go digging into it. But the composition, so we're going to kind of start high level and then we'll get more detailed. But the composition of the S&P 500. So if we talk broadly about just tangible, so companies in the S&P 500 that were comprised of tangible assets. So tangible being like railroads, oil companies, manufacturers, utilities, factories, inventory, land, equipment, like tangible assets you can see, feel, and touch. Versus intangible assets, this is something like code, brand, network, customer data. You were saying memory, AI models, patents, culture, talent, attention, things you can't touch, intangible. So how, just high level, has the S&P changed across these two areas. So in 1975, 83% of the S&P 500 would be categorized as tangible assets. So companies investing in tangible assets, only 17% in intangible. 2025, the most recent data we have, according to this report, 8% of the S&P 500 is intangible assets and 92% in intangible. That, I don't know, that shouldn't surprise me just knowing the economy we're in, but something about that was like, holy cow, that is not that long of time in the grand scheme of things. And it has completely shifted. So I want to stop there for a second, Rabih, and just, do you have first response or thoughts just on that key change?
I think
there?
it's reflective of our lifestyles, right? Back in the day,
Definitely.
How much of the stuff day to day that you interacted with were tangible? You would drive to the bank, you would go to a shopping mall, right? You would go and buy an actual, alarm clock to put next to your bed. Like all of the stuff that we consumed, we interacted with in our day-to-day life were tangible products that required brick and mortar to bring them into this world. And now, other than food, I live online, right? Like all I need is a UV plugged into my vein, and I'm good. Like I'm a vegetable at that point. Like everything I do is online, whether it was banking, whether it was communication, whether it was shopping, whether it was entertainment. Do you remember the days when we used to go to an amusement park and ride into these cars and Ferris wheel?
Rabih,
right?
I've been to Lagoon, shout out Lagoon Amusement Park where fun is in Farmington, Utah. I've already been there 3 times this year. So I remember amusement parks.
I'm jealous of you because my entertainment is scrolling on a screen, right? Lately. Well, I just came back from a trip, so I can't really
complain. Don't even talk your 10-day China excursion.
Can't really complain. But the point I'm trying to make is that those percentages are reflective of the time spent interacting with tangible experiences versus software. And they are the same. We changed our lives, and the companies that provided it became the larger portion.
Yeah, definitely. Yeah, a couple of things that come to mind for me thinking about this. As I heard this, I was, again, kind of blown away, just the shift. One thing that I want to get your thoughts on this, I would imagine it's harder to value companies now, or maybe just different. But I would imagine, like we've talked about, not to get too nerdy, and I'm not trying to get you going, Rabih, but if I bring this up, it might. But if we think about like book value of a company, is that kind of like out the window now? Like for a lot of these companies, can you really talk about book value being a metric that is as valuable or as accurate of something you'd even look at when you have like company not even based on anything tangible? Like I think it'd be difficult to actually look at that. So, and maybe you can explain more details about what we talked about with book value. But the first thing that came to mind for me is just how we even price companies and look at the value of companies now has completely shifted.
Did you know what you just did right now?
What did I do?
This is the equivalent of putting a big jug of ice cream in front of a kid and tell him, hey, don't get excited.
Oh,
You're telling me to explain
so nervous.
book
I was like,
value? You're
what
telling
did I
me to explain book value? Okay. So
it's like taking me to Lagoon and not asking me to take a ride on the rides.
Yeah, like exactly. So what you hinted at is very accurate. And actually, there was a period in the markets where investors are like, well, the value tilt in portfolio and small cap value tilt is not being captured like we used to. Did it disappear? Is it because the profile of companies shifted and now we do not know how to measure, this, we call it goodwill or the R&D, this goodwill in a balance sheet through a book value? There were adjustments to it. And the main adjustment was like, we're going to look at book value plus a value for these intangibles, for these goodwill, etc. And actually academic studies said that even if you change the measurement of book value and these intangibles and you use different metrics and different ratios, it's not going to affect the end result of your investment study or hypothesis. The stocks that you would expect, according to fundamental analysis, to do well will still do well, regardless of how you choose to measure them. But in terms of that measurement, just to get a little bit technical, because, I'm going to eat
You're
that
going to
ice
take
cream.
a couple bites of ice
I'm
cream.
going to take a couple bites of ice cream. Is that it is so easy looking at tangible, assets and valuing them, because tangible assets are there and you put them on a depreciation schedule. Piece of land is never going to depreciate, but if you get a factory, you will know that this factory, probably you can choose 20% a year of depreciation, and every couple of years you would have to upgrade the machinery so it can produce at the same amount of productivity. But if you have a coder or someone who's using their education and they're trying to give you a creative product out of there, while they're sitting there, how will you measure their depreciation of an intangible, of your research and development department? You'll either consider it as a marketing expense, just like you do with marketing. I'm just going to spend this and hopefully I get something out of it, which would mean now goodwill and all these intangibles are just expenses on your balance sheet. Or you would say, I'm going to go very technical and see what output this R&D, like how many breakthroughs this research and development company is making for me. And here's where actually work environment, quote unquote, started to get better. Now suddenly companies have lounges for their employees and they've got very flexible schedule. It's not just because we love each other as humans. It's because providing this environment prolonged the life of an intangible assets in your company. Now employees are more likely to stay in your firm and produce their creative thought to help you grow your firm. So you can't really measure intangible assets the old way with depreciation, but there are new ways where research, company, and I would call it HR, company engagement, patents, making sure you've got a good legal team to protect your intellectual property. All of these prolong the life of a goodwill and give us a better hint on which company has a better intangible versus another intangible. Company that has a lot of employees that keep switching jobs every couple of years versus a company that holds onto their employees and the employees themselves are growing in their field and learning more stuff every single day. Well, the second company has a higher value based on goodwill alone than the first company. A company with a good legal team with IP is better than a company that just gives its IP away. So stuff like that is how you would measure them. But I'll stop here instead of going into more detail.
No, this is great. I mean, I think we could easily relate this to dentistry, to a dental practice, where a dental practice has, just like every dental practice, has its tangible assets. It's got its chairs, it's got its equipment, the building, the physical aspects of a dental practice, and one might be more, it's easy to see like practice A versus practice B, the physical assets that are upgraded versus another, right? One's old and dingy and been there since 1970 versus one that's got all the best equipment in there. That's an easy thing to see. But just like we're talking, you're highlighting all these businesses in the S&P. Same thing with a dental practice. A lot of value is created in the intangible aspects of that: the patient experience, the reputation of the team, the referrals, the hygiene recall, the patient experience, the doctor's brand in the community or on social media. There's a lot of intangible aspects of that. And just like we see with dental practices, and we talk to dentists all the time about this, of like, sometimes that's hard to value. That's hard to see. Or sometimes it's so related on, like, let's just use the last example of like the brand of the dentist. That's intangible value of that practice. But again, it's tricky to measure that. It's far easier to just look at the balance sheet and like, okay, it's worth this versus that. It's really hard. And I think that's how it relates to dentists all the time.
100%. And while it is harder to measure, it does not mean that it is not there. Because
exactly,
a company that has a good reputation that can be easily identified, I'll even ask the dentist, like, why did you choose to go with Dentist Advisors versus a different company, right? Because we've got the
easy answer, Rabih.
See, because we've got very honest, humble goodwill, right?
Exactly.
So
leadership is so humble. Yeah.
So it is out there, even if you do not see it. But market fluctuations, how you interact with the market, how you maintain your clients when economic headwinds show up. This is what proves that this goodwill has value, and this is what maintains the value of these companies. So to deviate away a little bit from like dense advisors and like dental practices, when like COVID happened and suddenly everyone went back to order stuff on Amazon instead of just going to a brick or mortar or using Zoom, right? Instead of like Skype. Do you remember Skype versus Zoom?
Oh yeah.
They are both
Yeah.
software companies with zero, like a little bit of tangible assets, but their whole balance sheet is how good their code is. But because of customer retention, satisfaction, brand recognition, etc., the goodwill of Zoom actually proved its value and showed up in the
Dominated.
stock price. And Skype is a thing of the past. So
Yeah.
they are there, but you can't measure them every single day, just like you go and you measure how many years of life does my dental chair still has on it. You can only measure them when circumstances prove their value for you.
Yeah, that's a great point. A couple of other things I wanted to highlight here. I mean, then we need to move on, Rabih, and wrap up because we got to talk NBA. But I wanted to get your take on this. But is it safe to say that the more like the overweight of composition being in intangible assets now, just in the economy as a whole, can bring more fragility in some ways? Of like meaning reputation and attention, we're in the attention culture, can shift so quickly. And it feels like that can happen, that like those changes can happen faster in the economy that we have today versus maybe in the past, like just shifts in the intangible economy. Would you say that's safer to say that it makes companies that are maybe by nature more fragile?
I wouldn't say fragile. On the contrary, this R&D is as an asset, or goodwill as an asset, is much more mobile, is much more adaptive. Like if, for example, you had a car company and suddenly the design that you made was not really attractive, then you'll have to waste a couple of months until you make a new mold to create it. Whereas goodwill and how humans pitch an idea or provide a service, for example, or how we write a code, can be easily adapted to fit on with a fast changing market. What I would say is, I don't think overall companies are less robust, but what used to matter more to company valuation and revenue has changed. In the past, if an employee at a factory left, who cares, right? As long as the metal bending machine over there is still doing its job, we can keep the business running. But in this day and age, if your office building caught on fire, who cares, as long as my employees are able to provide the service. So what mattered to revenue and stock price has shifted, but the robustness of the business plan itself, I don't think has become more fragile.
Yeah, no, that's a good point. One other thing on this, kind of in the same vein, is do you think it's easier today to have, because of the economy we live in, maybe you've kind of said, no, there's no more like fragility than there used to be. In fact, there might be less. But the other thing that comes to mind is more opportunities to create gaps between competitions. Like you just mentioned Zoom and Skype. Like, is it easier today to have monopolies, just more specifically, with the economy we live in, of like a company which is better code or they just move faster than everyone else? It feels like, and that kind of bears out on the S&P right now with the composition itself, as we get into more detail here of like the actual market cap weighted breakdown of these companies. It does feel like maybe it's easier to gather all the attention or assets or capital compared to others.
100%. We were talking about the impact of tangible versus intangible assets on the robustness and the profitability of a company. But you can also think about the impact of tangible versus intangible assets on the dynamics of an industry and whether that creates high barrier of entry to new competition. Right? Back in the days, it used to be that only the entrepreneur with big pockets can they afford to take a loan to build the bigger factory, to produce at scale, to be more profitable. And then we later saw it early in the 2000s with tech companies. It was only the Googles, Facebooks, Apples of the world that are able to afford to create the new softwares, and they would eliminate everyone. The barrier of entry was so high. But then a technological shift from the outside called AI is reshuffling the paper.
Yeah.
So it's whether it's tangible or intangible will create certain industry dynamics where the barrier of entry might be high or low, but those are not static. And every time something happens to the world, whether it's positive like a technological revolution or negative like wars and pandemics and natural disasters, it reshuffles the card of who can compete in an industry.
Yeah, that's such a good point. We could keep talking about this, Rabih, all day. But we got to take the ice cream away from you.
Okay, yeah, I'm sorry.
We're going to pull the ice cream. But we did want to mention one last thing here. As we talk about the composition of the S&P, being the top 10 companies of the S&P by market cap from 1985 to 2025, and just how insanely big the S&P has become, but more specifically, the companies that are still around from 1985 to 2025. I'll just go through this really, really briefly. So, all the top 10 companies in 1985 that were in the top 25 of the S&P. Surprise, surprise, Rabih. Probably not a surprise. Not one of them is still in the top 10. There was only two holdouts until 2015, which is actually pretty impressive.
Who were they?
GE and Exxon.
Interesting.
So GE and Exxon, the biggest company by far in 1985 was IBM.
Mm-hmm.
In 1985, that's nowhere even close to being found in the top 10 anymore.
Yep.
They held on until 2025, so they still had a good run. GE again and Exxon held on until 2015. Now, even this is what's wild, Rabih. From 2015 until 2025, only Apple got bigger, and only two other companies hung on. So that from 2025 to from 2015 to 25, so 10 years,
Mm-hmm.
the top 10, only three are left. So
Yes.
Apple, JP Morgan, and then Berkshire Hathaway.
Those were the top 10 in 2015, and they maintained the status to be the top 10
sorry, I
in
lied. 4, Microsoft as well.
And Microsoft.
Yep.
Which means 6 others got replaced in just a decade.
Correct. 6 others in the top 10 got replaced in a decade. Every one of them from 1995, even if you go to 1985 to 2025, over that period of time, not one company is the same in the top 10.
Which
Kind of
is a
interesting.
great full circle, because our life, the way we conduct our day-to-day life is not the same as it was in 1985.
Yeah.
And the companies that provide the products and services shifted as well.
Yeah, exactly. So, okay, we've yapped too long today, Rabih. I wasn't with you last week. We just had to catch up and yap longer. We wanted to go into this. What does the NBA have to do with picking stocks? The question is, do we go into this, or do we hold it for next week? I'm not going to be here next week again, so we maybe should throw this. But Jake is. So Jake might be the one to handle this topic. What I'm going to give this to you on the spot. What do you think? Should we go into it?
Well, if we're going to give it to Jake, we want a 10-second take from you on what you think, and we'll compare it to Jake's answer next week.
Okay. Well, when Jake gave his answer, this was before the draft, right?
Yes.
Okay. So I'd like to get Jake's take after the draft,
Mm-hmm.
which he will give it to you next week. I'm going to throw this to Jake. He'll take this topic over. So you guys can, I think it's going to be you, Jake, and Will. You guys can talk about it. My take is Jazz got the best player, most talented player in the draft. Most talented. Not saying maybe most complete, but the player with the highest upside. The excitement level in Utah right now around the Jazz is as high as I've ever seen, which is amazing and fun, and I'm excited because I haven't been into the NBA for a long time. But it also makes me a little nervous. It also makes me a little scared. I'm like, are we hyping them up too much, guys? But I'm excited. I grew up on the old Jazz, 97, 98 against Michael Jordan. That was my childhood. So we've had some good runs. It'd be fun to see him competitive again.
Yeah, dude, any change that would make him a different team than what we had this season is a win in my books.
Yeah, I agree.
Yeah, I know.
Okay, well, we'll tease that. We'll push that to next week. We'll let Jake, Will, and you handle that topic. We yap too long. We want to be respectful of everyone's time. Rabih, any other final words on anything we talked about today?
Absolutely not. If I want to close this, we zoomed out for 6 months, and the market has been boring like it should be. All we cared is we reflected in prices a little bit more inflation. But life goes on, and we focus on what matters.
Love it. We're going to close it out with that. So it's amazing. Okay, well, If you're still here listening, of course, you're one of the cool ones. We appreciate you, Rabih. Appreciate you sharing your words of wisdom. If you are out there listening and thinking, man, I need help with anything to do with investing or your financial life, literally anything, any problems or questions you have around money, we are here to help. DennisAdvisors.com. You can book on the book free consultation button. And you'll get one of our friendly advisors happy to help and hear your story and see how we can help make life a little bit less complicated around your money. So we'd love to talk to you at DennisAdvisors.com. Again, for now, Rabih, thank you for being here. Everyone, thanks for listening. Till next time, take care. Happy birthday, Millie. We love you. Bye-bye.